British American tobacco. This is the consumer staple that is propping up my portfolio in these tough times, ladies and gentlemen. Large cap tech keeps taking these little beatings day in and day out, while names like British American Tobacco keep on chugging along, slowly making gains as people recognize there's a lot of cash flow at play here, and much less downside risk, as it's a lot of cash flow for not a very expensive price. At current share prices, BTI pays an almost 8% dividend yield with a buyback yield of about 1% over the last 12 months, resulting in shareholder yield of almost 9% total. And as the market starts to anticipate interest rate cuts, the risk-free yield, what you would get buying treasuries, is going to go down. As that goes down, people are probably going to look for somewhere else to park money and get consistent yield. And what is more consistent than British American Tobacco? Not much else out there, especially at this level of yield. Now, this yield probably will not last forever as money flows out of treasuries and into BTI. And if BTI continues to participate in their own buybacks, I think you could see their share price appreciate quite a lot. Now, dividends may not be free money, but they are real, and there are people that care a lot about consistent yield over time. And this is a stock that I could see being popular in a lower interest rate environment for that reason, because their cash flows are quite stable. Tobacco tends to be treated a lot like a consumer staple. Behavior of people buying tobacco doesn't change that much, even in recessions, etc. Now, while dividends are, potentially taxable and that kind of thing, and the money comes from somewhere, it's not free magic money out of the sky. What is actually free is the stocks you get for signing up to our channel partner. Of course, we're referring to today's sponsor, which is Moomoo. You can support the channel by following my unique link in the description. If you do that, when you deposit $1,000, you get 15 free stocks redeemable in their mobile app, as well as access to a bonus APY of 8.1%, as well as margin rates as low as 6.8%, and of course, more trading indicators than you can shake a stick at. I also do keep a link to this handy in the Discord, which is also in the description. So feel free to hop on there and talk about it as well. But other than that, I do encourage you to give Moomoo a try and see what it's all about. A lot of people are doing it. I'm certainly impressed with what I've seen so far. Now, let's discuss valuation a little bit on BTI. Okay, so we have basically a price to free cash flow of 6.3. Now, it was below 5 when I started to really notice and press the gas on accumulation here. So I'm up a good amount as that multiple has expanded a little bit. But their nearest peers, Altria and Philip Morris International, both have multiples over 10, which Altria has something like an 11, I think, times price to free cash flow at today's prices, and Philip Morris International, I think it's like 16 or 17. Now, I don't think BTI is going to get that Philip Morris multiple because they don't have Zins and some of the other stuff. They don't have Marlboro, which is the biggest, most popular brand internationally, but I do think they deserve to be at least the same as Altria Group, since Altria Group is exclusive to the US where smoking is on the decline. BTI has that international exposure, the exposure to the emerging markets and everything else. And they have a lot of well-known and popular brands under their belt as well. One thing that could potentially hurt them is maybe if the menthol ban comes back onto the table, maybe that could affect them some, but that's a pretty limited effect, to be honest. And I think it would hurt their peer Altria to a certain extent as well, I believe. So I think BTI is the most undervalued of the three big nicotine companies, and probably has the most upside potential, most potential for multiple expansion, and the most accretive buyback program. Now, also, let's also consider how defensive something like BTI can be. On a day like yesterday, where QQQ was down 3%, BTI was up 1%. BTI is also the second largest holding in my portfolio. So while other people were really, really reeling over how down their portfolios were, most people were down between 2 and 4% from what I was seeing on like Twitter or X, whatever you want to call it, and other people on other Discords, etc., talking about how down their portfolios were. Not the case with a heavy allocation into BTI. Granted, I don't have a lot of Mag 7 type stocks that are a big part of what was driving the QQQ down. I do have Amazon, although it was down a little bit less than the overall QQQ was yesterday. So, frankly, during these kinds of times, it can be like a little bit of a comfort to have something like BTI that's up even when a lot of other stuff is down. And if interest rates go down, that yield will look pretty attractive to people who invest for yield. I don't personally subscribe to the idea of just investing for yield, but there are people out there where that's kind of what they're looking for. And in tough times where people have a hard time justifying the high-flying valuations in tech, something that's trading at 6, 7, 8 times free cash flow, that has a pretty good yield, that's very consistent, that's been around a long time, that consumer behavior doesn't change much during recessions, that'll start to look a lot more attractive, and you could see that multiple expansion to 10, 11, 12 times free cash flow, possibly. So that's why I'm pretty heavily allocated into BTI right now. Let me know what you think about that. And I will say, you probably aren't going to be getting a whole lot of growth out of something like BTI. Some markets for tobacco-based products are in decline. Others may increase somewhat. And I think on the whole, it kind of balances out. In the markets where it's declining, they're slowly trying to replace that combustible revenue with things like vaping and oral nicotine and that kind of thing. And so it sort of all seems to level out at the end of the day. You might get slight, slow, steady, inflationary type increases in the revenue, but I don't think you're going to get like 7, 8, 9% consistent revenue growth over time. I just don't think that that's reasonable. Their EPS may get driven up due to buybacks, plus a little bit from the organic revenue growth, but this isn't really a growth engine, right? This is a mature company that's been around like 100 something years. They're going to just kind of sit here, produce their cash flow efficiently, and pay out a consistent amount. And when the stock is cheap, they might do some buybacks to drive up EPS. But that's really where you're going to get most of your value from, is how efficient they are and how much they drive back to shareholders through buybacks and dividends. And of course, any multiple expansion that happens due to a quote unquote flight to safety. Those will be where you get your gains on BTI, in my opinion. So people may be wondering, oh, what's a DCF model say about BTI's current value? And this is sort of just a very, very ballpark, rudimentary kind of thing. But we'll suppose a discount rate of 10%. We'll suppose the trailing 12 months of free cash flow continue on into the future and grow at something like 5% per year. And that's on a per share basis, which is potentially doable. We'll knock them down for the Negative tangible book value, they do have a good amount of leverage on their balance sheet now. This could be considered a little bit harsh since they do own a lot of different brands, and so some of their non-tangible book value, some of their goodwill, etc., may actually represent some kind of a real value if they were to sell or spin something off. But the buyers would be limited and that sort of thing. So whatever, we'll just discount it. We'll be cheapskates on this. And even still, with these kind of assumptions, you come out somewhere in the mid 40s. And my sense of this is that it's probably mid 40s to low 50s. You could argue for a slightly lower discount rate for the consistency and the moat and that kind of thing. The fact that they return most of the value directly to shareholders with buybacks and dividends. You could assume a slightly lower discount rate just because of that, and the relatively low risk, etc. But either way, any way you split it, I think probably most people would agree that it's definitely worth more than 6 times free cash flow. So I do think there is some room for gains here, and in the meanwhile, you get a nice shareholder yield while you sit around and wait. Feels pretty good. I don't really, I don't lose any sleep at night, we'll say, holding a heavy position in BTI. If you made it to the end, I would like to thank you very much for doing that and supporting the channel. If you want to support it further, of course, you can sign up for our sponsor, or, even just liking the video for the algorithm and subscribing. Help me get to 3,000 subscribers. It's the next big goal on the channel. Join the Discord, link in the description. I will never charge you for that. It is just a free place for in-depth discussion about stocks and any other investments. A lot of very smart people in there. There's people in there that are more experienced and better than I am. Certainly people with more money, people with less money. We have all walks of life in there and different perspectives on different investments. Also, catch me every Saturday, 8 p.m. Eastern, Cash Flow Kings Live. And follow me on the X platform, Elon's sandbox, as it were, at Mr. Macho Mog, link in the description. I don't only discuss investing there, but it is something I discuss. Trying to get to 500 followers on there. And when I do, I will be doing something very cool. Take it easy, everyone.